I'm Ernie Humphrey, Educational Programs Leader for Performative, the largest online community for corporate finance, accounting, treasury, and related professionals. I'd like to welcome everyone to today's webinar, A Holistic Approach to Accounting Close and Reporting Effectiveness. It's so much more than technology. The accounting close and financial reporting each occupy a unique position among business processes. While recognized as critical processes and the subject of increasing regulatory scrutiny, the close and reporting processes have been remarkably resistant to the type of re-engineering efforts that have improved performance and productivity in less critical areas. Many companies are looking at cloud-related technology to drive improvements in their accounting close and reporting effectiveness. However, technology in and of itself does not improve manual processes. If technology is implemented without proper consideration for process and people, it can negatively impact accounting close and reporting effectiveness. Each company's unique accounting and reporting requirements dictate that a total solutions approach focused on continuous improvement offers the best path to successfully improving the quality of financial close and reporting. Today, our featured speaker will offer specific techniques and tactics that can be leveraged by your company in taking a holistic approach to accounting close and reporting optimization. A quick note on today's agenda: first we'll hear a presentation from our featured speaker. They'll move into the interactive Q&A session where we'll spend the remainder of our hour. We can't promise to get all the questions in, but if we do not, we'll follow up with those afterwards. If you have any questions at any time, please go to the questions area in your GoToWebinar control panel and send us your questions. A few more logistical notes about today's webinar. A link to today's presentation and video of the webinar will be sent to all attendees within 24 hours of the event. Those who would like CPE credits through NASBIT will need to answer all the polling questions during the event and should have pre-registered for CPE credit. For any questions on CPE credits, please send an email to cpe@performative.com. Again, we encourage you to ask questions on today's topic at any time via the questions box area in your GoToWebinar control panel. Finally, we ask you to take a short survey today regarding the webinar today. We greatly appreciate your feedback regarding our event today, as we always strive to improve the ROI we offer our event attendees for their valuable time. A quick word about Performative. Performative is the largest online community and resource for senior-level corporate finance, accounting, treasury, and related leaders. Performative connects corporate finance leaders to provide instant advice and insights on the tough financial and strategic challenges they face every day. Let's go ahead and get started by introducing today's speaker, Gabe Zubaretta. Gabe's extensive experience working with accounting and finance teams includes audit and acquisitions management experience at PricewaterhouseCoopers and SEC reporting and finance director roles at both public and private companies. At Silicon Valley Accountants, Gabe has led clients through process improvement related to managing external audits and achieving SOX compliance, in addition to several acquisition, integration, and financial cost streamlining efforts. Since founding Silicon Valley Accountants, Gabe has helped design and successfully implemented a financial process optimization software solution for public and non-public clients. He is a CPA and educator in revenue recognition and other current accounting topics, as well as process optimization. With that, it is my distinct pleasure to hand the floor over to Gabe. Gabe, please go ahead and take it away for us. Thank you very much.
Hello, everybody. How are you? Good afternoon. I'd like to get started with our course, and thank you, Ernie, very much for the introduction. So, a holistic approach to the accounting close and reporting effectiveness. We have an agenda and goals. Ernie already introduced that, so we're going to move forward a little bit, and we're going to start off with a question. How long has the accounting close and financial reporting been a challenge? Since ERP was introduced, longer than I've been in accounting, forever, since Sarbanes-Oxley, all of the above, none of the above. Most of us who have worked through this know that we've been challenged with this for a long time. Why? What goes on? Let's take a little step back and look at all the challenges in today's current business environment. We have the economy, which keeps going up and down. Government shut down now. Maybe things get a little better. Changing regulations, SOX and MAR, the PCOAB. Recently, the PCOAB has been saying that there's not enough evidence of review. Auditors are reacting by forcing us to do more for audit and show more in evidence of review. Audit committees are putting some increasing pressure. Fraud. Somebody commits a fraud. Who pays? All of us. Everyone involved in financial reporting ends up having to do more every time somebody does something wrong. Whistleblower and FCPA concerns. What about the future? What does the future show for us? We're going to have more technology and more technology and more technology, which keeps making change and change and change, and also competition. So how does it look for everybody? Well, I set up this example to kind of say, over the last 100 years, what has happened to the speed of change? And I broke the last century into thirds and said, it feels like change keeps getting faster. The important part here is what is happening and what is going to happen in these next 30 years. We're already about a third of the way through there. What do we think is going to happen? Is the world going to get slower with change, the same, or is it going to get faster? I think most of you would agree that change is not going to slow down. Change is inevitable. It's going to keep hitting us. So what happens? In today's world, people are saying things like the CFO needs to execute on a much broader range of responsibilities. Finance needs to focus on financial function effectiveness. We need more quality and consistency, internal controls, corporate governance. CFO must be increasingly responsible, practical information, risk analysis, performance analytics. Read the last line of this. A common obstacle is that finance teams set the wrong priorities. Who could possibly be saying this stuff, right? Who could be saying stuff like this? What's driving all of this? It couldn't be our thought leaders. It couldn't be the people that are out there in the world explaining and talking to people and telling them what should be expected of accountants, right? So what's happening in industry? In many organizations, the CFO is seen as a number cruncher, sitting in an office, applying procedures, saying no to budget requests. Anybody know a CFO that said no to budget requests? The challenge is to create an environment where the CFO is encouraged to expand responsibilities, take an active interest in every area of the business. Who could possibly be saying this? It couldn't be people straight from industry. This was a financial roundtable. What about today's organizations are squeezing the finance function, resources are increasingly scarce, must maintain controls, compliance, keep up with complex accounting rules, all while meeting demands for faster turnaround and lower cost. What about this last one? The financial function must undergo a fundamental change and realignment in order to transform. We've got to go from being transactional to being more cost-effective and strategic value. Who could possibly be saying that? You wouldn't want me to leave any of them out, would you? Right? All of the thought leaders are pounding that more has to happen with less. It's not just us. In the past, we were viewed as number crunchers, bean counters, historically focused, too busy, internal controls. Now what do they want? They want us to be internal consultants, have a seat at the table, business advisors, an expanding role. And they want us to go from one to the other, so that's going to require a transition, maybe some transformation. And do they want us to do that? Do they want us to change our role? No. They want us to do both. Hey, by the way, automate the past and do all the stuff, keep raising the bar, and more resources? No, less resources. So how does all this come about, and what do we look at? We look at the effectiveness of a department, and we realize that the effectiveness is determined by a combination of the people, processes, and systems. We came up with a rating scale and a way to visualize it. So even if you have the best systems in the world, the title of this, it's more than just technology. Imagine you had the best systems in the world. In our world, those systems would be rated a 2.0. Okay, the best systems in the world, but your people were siloed and your processes were limited, and they were very initial. What happens? Numerically or qualitatively, you end up with low effectiveness. Why? Because those are limiting factors. What's happening in finance is we spend a ton of money on one part and we ignore the other part. Finance is all about everybody working together to get things done. So again, imagine if you had the best teams in the world, the best systems, but your processes were very limited. Now what happens? You're still experiencing bottlenecks, and that affects your effectiveness. Even if you rank the best you could in both of those, if you have a low rating in the other one, your effectiveness is limited. So what's the answer? The answer is to take that holistic approach, to look at things and take a much more balanced approach. You don't have to maximize everything. The latest and greatest system with every bell and whistle is not going to do things. You've got to balance your resources. You will double your effectiveness by being more balanced than you will by putting a lot of pressure and trying to force things through chokeholds. So I did a presentation with APQC. These are the folks that do Malcolm Baldrige Quality Award. We talked about process improvement in finance. We were focused on CPM and reporting, and we asked, what do people want? And these are APQC survey slides, so I thank them very much for the right to use these. And if you look at this, did people want efficiency? Did they want effectiveness? Over 70% of them said we want efficiency and effectiveness. And where do they want it? What are the most popular targets? Budget, planning, forecast, replanning, consolidate, close, report. Why? Why are those the top targets? because they're the most manual, they're the most bottleneck filled, they're the most limited processes that we have. Now this was a very interesting chart from that presentation. And you're going to have to follow me for this one, and it's a little bit complex. What this was trying to show you is that the best companies, what APQC does is it ranks companies into quartiles. And so they showed 3 of them here, and the bottom performers, the medium performers, and the top performers. And they had 3 different styles of doing accounting. The BU, or the business unit type accounting, the headquarters-based accounting, or the shared services. And what they were measuring was the time between completion of the consolidated financial statements and release of earnings, which you would like to be as little as possible. So the top performers had lower numbers, the bottom performers had higher numbers. That makes sense. And what they showed was, regardless of which category you were in, whether it's the bottom performers, the middle performers, or the top performers, the companies with shared services were the most efficient. Well, that makes a certain amount of sense. Shared services has only been created to make efficiencies. So that makes sense. Now, if you look at this, I read this completely differently. Because their point was shared services is the most effective model, is the most efficient model. I get it. Watch this, though. If I'm in the bottom performers, and maybe I'm the BU of the bottom performers, I'm the slowest guys on the block, and I want to make improvement. Let's say I want to get to that 20 days. I have to put in a shared service center. I have to put in a big piece of software. I have to change a lot of things. I have to do a bunch of stuff, and I can get to that 20. But look at something else. I can just improve what I already have. And I could get to 20 just by doing a better job at my BU reporting. So does that hold everywhere? Well, if I'm at the 20, if I'm the median BU, and I want to go to something better, I could change, frankly, to shared services or headquarters and pick up an extra 5 days. Or I could just get better at what I do and get down to 12 days. The way I read this slide is that the best investment is to improve what you already do. You don't need a great big system. You don't need to go through a great big implementation effort. You don't need to spend a ton of money. What you need to do is you need to work on the effectiveness, generally on the people and the processes. There's some work to be done with the systems, but it's generally more minor. You probably already have a gigantic ERP system and et cetera. There's maybe some things you could do to improve that. But the reality is that it's the people and the processes that are generally the bottlenecks, and what you can do is get better at what you do. Look at the headquarters model. If I was at 23.5, a headquarter bottom performer, and I wanted to get better, I could switch and pick up 3 days by becoming shared services, or I could get to 15 days by just getting better at the BU stuff. And if I'm a 15-day BU, going to shared services doesn't give me anything. But if I improve what I'm doing, I can get down to 10 days. And let's take the top performers, because assume that I'm a top performer in headquarters. I'm at 10 days. I'm going to make a ton of changes. I'm going to invest a lot of money. It's going to take a lot of time and effort to try and get to be a shared services top performer. And if I slip a little and I end up as a median performer, I've just managed to invest a lot of time, effort, and pain to go backwards by 5 days. I'll say it again and again. Improving your processes, improving your people, improving the balance will save you money, and it'll get you the greatest gains. Good processes are less expensive. So here's the total cost of financial reporting. Again, we did not come up with any of these slides. These are APQC slides. They were licensed from them. They were prepared before I ever started doing anything with them. But this was a very interesting slide, the total cost of financial reporting for $1,000 in revenue. Look at the bottom performers, 57 cents per thousand. Look at the top performers, 11 cents per thousand. We are not talking about a minor savings. We're talking about a 5x differential in what you're spending. This was companies with revenues of greater than $1 billion, and there were almost 150 in the sample set. So this is not a small sample. This is not that. And APQC is not out there to do anything other than help people improve what they do. But it's staggering when people ask me about ROI and is there ROI, right? There's huge ROI. The final one, and again, I didn't do anything, the fast close costs less. I did not change this slide at all. The faster close costs less. So if you're concerned about ROI, does it make sense, can it be done? These are companies that are doing it, and what they found was that the slowest companies are spending significantly more on their close than the faster companies. Closing faster does not cost more. It saves money. So here's another definition question. What is the accounting close in financial reporting? Is it an event? Is it a process? Is it a rite of passage? You are not a real accountant until you've done this 24 times. The title will be bestowed on you. I survived the 2-year ends. Is it a fun time? All of the above? None of the above? Why does every one of those answers have a little bit of ring of truth to it? Even the fun time, right? Late nights, fast foods. That's what powers the close, late nights and fast food. It sounds like a party, good friends. Could be a beer commercial. The reality is it's an important financial process, or it should be an important financial process, although often it feels like an event. And it does have a lot of rite of passage and badge of honor stuff to it, but it should be a process. Why is it different than other processes? What is different about the close than other processes? Well, 1, the close changes frequently. 2, it's the catcher of miscellaneous. The truth is that if you work in an organization with salespeople, you know this dynamic. Salespeople can only sell big, ugly, hairy things when? End of quarter, end of month, end of year. And then what do? They come in with this deal that's half-baked, they flip it over the fence and throw it to accounting and finance and say, hey, you guys got time to deal with this during the close. It's a little unique, see ya. So anything that people change, we find out about later. Right? We're reconciling an account and we find some stuff and we go, what's this? And somebody goes, oh, we had to tell you. So it has all the miscellaneous stuff in it. It's always changing. Let's talk about grading scale. So everybody remembers the grading scale from high school, 60 to 70, 70 to 80, 80 to 90. We're going to be asking you to grade your close a little later, so think about grading scales. Now here's an interesting question for you. When we think about grading scales, like my daughter recently graduated from high school, went to college. She went to a high school where between 93 and 94 you went from an A to an A minus and you lost some GPA, and if you were in an AP course it was multiplied, whatever. She got to college. I get a call 6 weeks after she started college. Dad, I just had my first midterm. I got a 77. I'm thinking, here comes the meltdown. 3, 2, 1. Dad, the curve was 55. 77 was an A. This place is awesome. I love college. So grading scales can vary, right? And our perception of grading scales can vary. Well, every one of you has somebody who works for your company who's kind, gentle, caring, understanding. You probably recognize them, the CFO. So let's talk about the CFO's grading scale on the close. If you come to the CFO and you go, hey, great news, I got 93% of the close done. You think that's an A minus? Because it's probably an F. Hey, I got 95% of it right. An F. Imagine that you did 100% of it done, 100% of it right, 100% of it on time. What grade are you headed for? Now, if he's really kind and gentle and caring, it'll be like a C. Hey, you got your job done. Some of them will be happier. And then all of a sudden you say, well, we got it all done, but the auditors say we have 2 material weaknesses. You're right back to F. So the CFO grading scale is rather difficult on this. The thing's changing all the time. You're under time pressure. There's a lot of manual activities. Does this sort of set the stage, and then things keep changing, and we're under pressure? It sets the stage for why it's so unique. It's called the last mile of the financial process, and if you think about it, it has some other unique things. If on day 3 of a 6-day close, the CFO comes up to the controller and says, where are we in the close? You've all been there. What do you say? Working hard, nothing's blown up, on track. If you graduated from controller school, you know that the only thing you have to do is keep rotating the answer so it doesn't sound like you're just saying, I don't know, I don't know. But the reality is you can't see the close. Very few of us can tell who's where. You can go ask your people where they're at. What happens when you ask somebody where they're at in the close? Hey, how are you doing on the close stuff? Fine, I'm busy. They're fine and they're busy until something goes wrong. And when something goes wrong, you find out about it late. If something's due on day 4, when do you find out it's going to be late? Usually around the end of day 4 or sometimes on day 5. So you don't have any visibility to this, and the process lacks a lot of visibility. How is it managed? Should Excel be a close management tool? Should we be looking at it like we look at other processes? Let's look at this pictorially, the GL, paper, manual, spreadsheets. Today, ERP systems. AR and revenue, again, a long time ago on paper and manual, spreadsheets and simple systems, sometimes moving into the ERP, sometimes RevPro or SoftTrax. What about payroll? Is payroll important to you, at least your own? So payroll started off with the OneWrite system and other things. Today, ADP. Now, I have a question for you. Could you do any of those important financial processes today on paper or in a spreadsheet? Absolutely. Would any of you do it? Absolutely not. Okay? So you gained efficiencies. Today, ADP would tell you they've spent $1 billion on research and development. What are they research and developing? What are they doing? Well, the research and development that they've spent money on is process control feature functionality. So I asked a question to begin. What is the accounting close and financial reporting? Is it an important process? If this is an important process, how do we manage it? Think about that for a minute. So what I'm going to do, and I told you I was going to ask you about grading your scale, your close. What I'd like to do, and this is an interesting exercise we do when we do this live, is we ask people to grade their close. A, it's great. I look forward to it every month. B, it's pretty good. We get it done. We do a good job. C, it could use some improvement, right? It's okay, but it could use some improvement. Or D, it really could use a lot of improvement. We would classify it as bad. What's interesting with this poll is that most people, when you ask them, and we do this all the time, you ask them to guess what the poll results are. And most people will guess something. But what's funny is when you look at the poll results, it's different than what most people guess. So before we would show you the results, I want you to guess what you think the average would be. Do you think most people are going to say great, good, okay, or bad? Now, I can't hold you to it. Usually in class, I have people raise their hands, and the most number of hands people say when they do this, the most number of hands come out and they say C. We think most people will grade it a C. What you're going to find out is something very interesting when we look at the results of the poll, because although a lot of people would say C, the real answer will surprise you, because the real answer is B. The reason the real answer is B is because most of you get it done. You do a good job. You are dedicated accounting professionals. No matter what happens, you're going to get it done. So we're not saying you're broken. Okay? I'm going to take a guess that there's not a single person on this phone that has ever said to a CFO, you know what, the close, it's just going to be too hard this month, and why don't we just close twice next month? Never going to happen. You are dedicated individuals. You absolutely will make sure that it gets done. So the reality is that the close is that you do a good job on the close and it's not broken. So this brings us to another interesting question. Do you have time to improve the close? And now this is one of my arch nemesis. I have two arch nemesis in the world. One of them is this question. Do you have time to improve the close? Because you know what the majority of the people tell me? Oh man, you wouldn't. We're just too busy. Can we try in next quarter? Can we try after the year end? Can we try after Q1? You know, we're in the summer and everybody's. And now we're coming upon Q4. Everybody always tells me that they're too busy. Well, what are you too busy with? Well, you know, we got to get the close done, and then when the close is done, we catch up on our day jobs. Yeah, you call them your day jobs. We catch up on our day jobs. And then when we're all caught up on our day jobs, then what? Right back to the close. So the funny part is, if you're too busy to improve the close, you're frankly too busy not to improve the close. The close is the single largest consumption of time in most accounting departments. It involves more people for more time than any other single activity. And the close can be improved a lot. And if you take a company and you reduce effort, and we measure effort in terms of days, if we take your close from 14 days worth of effort, maybe you start at negative 4 or -5, you're done day 9. If we can take 2 days worth of effort out of that close, what have we accomplished? 2 days, 12 months, 24 working days. We have managed to create an entire extra month of productivity for your people. And you don't have to close that month. Entire extra month that you can be proactive, value-added, predictive of problems, improve process, etc. So just taking 2 days worth of effort. And we've worked with companies and we've taken 3, 4, 5 days worth of effort out of their close. And it's completely transformative. It gives them a ton of time. And trust me, you have plenty of things to do at the time. There's not even a concern that you won't have anything that you could do with that time. So what's my next nemesis from this perspective? Well, okay, so it makes sense. So when should we start? Well, I help a lot of companies. I travel a fair amount, and I was in Detroit, and we finished one day, and I found the world's best bar. Huge sign, free beer. What could be better? Bar, free beer. Big sign, little sign, tomorrow. See, the truth with the close is it's never going to be the highest priority. And the reason is because you're always going to get it done. So people can always put off and put off and put off and put off improving their accounting close. Well, it's on the goal of a lot of audit committees. It needs to get done. We suggest you start earlier and that you get it done. So let's look at the close. We called it the last mile. We said it was unique. What is the issue with the close? Everybody focuses on the ERP system. If only we had another module, if only we put in a new system, if only we upgraded. But the reality is that you're using the ERP, but fixed assets for many companies, yep, the ERP could do it, et cetera, but they might have a specialized fixed asset system. What about revenue? Revenue, every ERP system in the world can do revenue. Okay? But many companies use a revenue module, soft tracks, all sorts of different things. ERP is wonderful. I'm not speaking against ERP. ERP has 3 basic functions. 1 is to standardize data, 2 is to make sure you can run a ton of transactions, and 3 is to hold that data and not lose it. And it does those 3 functions extremely well, particularly for your more standard transactions. Reporting, 10 minutes after you buy an ERP system, you're usually hearing Hyperion, Cognos, Crystal, anything else. Either that or they've ended up buying a couple of those. But regardless, the canned reports, everybody needs their own information. Let's look at something as elemental as payroll. Every single ERP system in the world has a payroll module. What percentage of US-based companies use the payroll module of their ERP system? It's less than 10%, probably more like 5%. Everybody else is using Paychex, Ceridian, Payday, ADP, Workday. Everybody's using something else. So when it comes to closing, it's not about one system. It's not about what you do in that system. It's about what you don't do in that system. It's about those spreadsheets that are all over the place. It's about everything else and that process. Now, you remember the promise of ERP 20 years ago, okay? You put everything in our system. You hit one button, you get financial statements, footnotes, and all. How's that working out for everybody? The truth is we're all unique. The ERP system focuses on the more standardizable stuff, and everything else is being done by whom? A bunch of happy accountants just like you. Do you see how we found accountants with smiles on their faces? So the reality is the close involves everything. And let's look at that process. How many companies in the U.S. use their ERP's FAS 109, tax provision, footnote disclosure preparing software? None, because they don't have it. How about the automated EPS calculator? Doesn't exist. How about the fair market value level 1, level 2, level 3 disclosures? Doesn't happen. There's a very small handful that use it for XBRL. Most people are using web filings or something else. If you do a merger, the next month, you know what you use? A spreadsheet. Their numbers, our numbers, AJE1, AJE2, AJE3, and then you start in integration. And your process keeps changing every month. So we're going to look at the things outside this red circle and inside this red circle. How much money has been spent by the ERP companies and by all these big system companies on developing that software? Billions. It costs millions to buy it, and it does everything standard. but everything that doesn't work in there gets thrown into the red circle. Where do your auditors spend the most amount of their time? Where do your issues come from? When was the last time your system told you, you know, I got a better offer from the company down the street, so I'd like to give you my 2-week notice? Does your system have to run out and take care of its child? Does your system have to, you know, a death in the family and that stuff? Doesn't happen. There. So let's do a little survey here and ask a question. What percentage of your issues are coming from the red circle, and what percentage of your issues are coming from the others? So I think we're at a polling question. Then we're going to try and figure out what percentage of your challenges are coming from one place and what percentage of your challenges are coming from the other place. So the potential answers are less than 50% of my challenges in the close are coming from in the red circle, 50 to 80, greater than 80, or I'm not involved in the close and I'm a very happy person. That was a joke. The answers are less than 50% of the issues and the problems come from the red circle, more than 50% but less than 80, or greater than 80. Okay. What do most people think? If you're involved in the close, where is the trauma and the drama coming from? Is it coming from the systems? Is it really a systems issue? Or is it more of an issue of the manual, the subjective, and all those other things? Where are the issues coming from? So we're going to go ahead and get moving from here, but I think that what you'll find is that the answers are the majority of the issues are coming from within the red circle. Okay? And that doesn't surprise me because those are the most manual entries and the places where most of the challenges are. So I believe that we've so combined over 50%, there was 42% in the 50 to 80 and 20% in the other. So we're almost at 70% are coming from the red circle. The question is, what are we talking about? How many activities are people doing? We refer to these as electronic work papers, and we look at how many activities a company would be doing coming out of their close. These are manualized activities outside your ERP system that generally require a work paper, a signature, a preparation, a review, etc. Okay, these are the supporting documentations: reconciliations, journal entries, analysis, accruals, disclosure meetings, footnote support, etc. How many activities? That's a lot of activities. Notice there's no rounding because we track every single one of them. We work with people to understand every single activity that they do. The close changes every month, and even when there's no quarter involved, like October and November, you get a lot of variation in the close. So IOMA did a survey. The survey talked about assigning responsibility for resolving discrepancies, establishing clear accountability, enforcing deadlines, clear and regular close communications, metrics, and continuously improving the close process. We have a course where we'll talk to you about all of these things. The course is designed to have a methodology to help you with technology, talk about performance metrics and communication, to help you with best practices, and how do you get focused resources and a strategy to execute a process improvement on the close. And most of this does not involve having to do technology. A lot of it involves Six Sigma. It involves being focused on your end user, improving process, improving teamwork, and working on the data and the metrics. Who are the customers that we're interested in? We're interested in the users of the financial statement product and the preparers. The users want accuracy and completeness, visibility, manageability, completeness, and no surprises. The preparers want a process that's easier, better, and less stressful. All of that will yield speed. Improving the process, when we go through and we look at the close process and we look at any particular part of it and we ask the question, why do you do things this way during the close? What do you guys all answer? You all say, well, that's the way we've always done it. Imagine that that's the way we've always done it on a process with 500 steps, and there's another golden rule in the close. If it's not broken, don't fix it. If you have a process of multiple hundreds of steps that you always do it the way you did and you never fix it because it's not broken, you're not going to have an efficient or an effective process. We show you how to use lean methodologies, how to talk about strangers and repeaters and runners. We show you how to do trial and error. We show you how to do a bunch of other stuff to continually improve this process. You look at a 14-day close. This is a company we were working with, very little in the pre-close. They start on day 1 and they're done on day 14. By September, they're starting on day 1, but they've managed to pull a lot of stuff into pre-close, so they're very ready, and they're doing some activities ahead of time. They've pulled some things into post-close. Post-close is things that were non-critical activities that were being done, and they're done by day 10. That's within less than 6 months. They've already shaved 4 days off their close, and if you look at the choppiness of the top, it's a lot smoother in the second one. Here's their year end. Again, they pulled a lot out to pre-close, started on day 1, pulled out post-close. We weren't done till day 10, but they were very close to being to an 8-day close for the year end. They've gone from a 14-day monthly close to almost an 8-day close for the year end. That is continuous improvement, and it's not a system-based answer. Teamwork, it's all about improving the teamwork. It's all about making sure that you can make sure that your teams are doing the things that they've got visibility, communications, manageability. Use teamwork to set goals. Measures, you need to understand the metrics. You need to be able to see what's late and what's early. In this case, the things that were late were causing some issues. The things that were early were time that we could reallocate. This was March. If you could see it and you could focus your efforts and you could figure out what issues were causing it, by April you can actually make a big difference. This is actual customer data, so this is not, sample. This is customer who focused on reducing their late activities. They had less early activities, but they're further along. So now we're going to ask a polling question, and which of the 3 principles are Lean Six Sigma principles? Now, I know we went through those quickly. Is it very facts-based? Is it very end-user focused? Is it the last mile of process optimization, involves estimation, or teamwork focused? Remember, we talked about these things. We talked about that Lean cares a lot about the end user. It cares a lot about process improvement. It cares a lot about teamwork, and it cares a lot about facts and data. So please answer your polling question. The polling question is not designed to be right or wrong. It's designed to have you here and to make sure that you're listening and that you're clicking buttons. So we're going to go through and talk about how the solution and how things look. So we're going to go ahead and close the poll up. Most people got it right, and we're going to go ahead and get back to what we were doing. Yep, most people got it right, very much so. Teamwork, end user, and facts-based. The one that was missing was the continual improvement. So now we're going to talk about looking at this in a different way. This, it says, there's a book called Fast, Close to the Max, and he has an analogy about it's the reporting supply chain. All of the events around the group reporting process, including the extremities. I like to say especially the extremities because it's generally the small things that cause the big problems. If you think about the way the close is done, if this close started on day -3 and finished on day 9, it would be a 12-day worth of effort close. What are the chances that we do 8.75% flat line effort all the way across? Not very likely. Usually what happens is that we focus on getting started, we cross the month end, we hit a peak, and then we come down and we finish on day 9. If we could see those last activities and what's forcing them out there and which errors are occurring that are being resolved on day 9, we would have to deal actually with a very small percentage of the activities to actually be able to cut off a good number of days. This whole point is about being able to prioritize, is about being able to understand. If we look at the review, how is the review done? The review is done exactly the opposite. We focus on get it done, get it done, get it done, and then what is the most productive time of the close? It's usually Friday between 4 and 5 p.m. Hey, I know I was behind on a bunch of stuff, but I managed to fix it all up, and here it is, and here's a big pile of work. I got to go now. I'll be available this weekend. I've got my cell phone. Don't worry, it won't get any coverage. Okay? The reviewer knows this because it's when they get slammed with all the review, and they got to get it all done before they're finished. If we analyze this, if you make an error on day 2 and you find it on day 2, the effect is minimal. You make that exact same error on day 2 and you find it on day 8, the effect is much larger. In terms of optimization of process, if you do a task on day 2, when should you review it? Day 2, day 3? When do you review it? Those curves would tell you that that's not the way it works, and what we need to do is be able to move the review closer to when the work is being done. We need to be able to see it, and if it's a high priority activity, we need to even be able to prioritize it. Now, what is the best review of financial statements? It's called analytic review. It's what happens when the CFO takes the financial statements, is looking through them and says, wait a minute, this number is not right. Is anybody willing to bet against him? Generally not. Because generally he's right, he's done an analytic review, but when do we do analytic review in the close? When and if there's extra time at the end. Does that make sense? Because if you were looking at this as supply chain quality, you would say it makes no sense to do our best QA activities at the end. You need to be able to identify when a group of activities has been completed, when they've all been reviewed, and then you need to do what's called disaggregated analytics and move your analytics forward. If you're building a car, you check the quality of the steel at the beginning, not at the end. Did I invent this? No. If I had, I'd own an island and I'd be there right now. The reality is that this is the basis of the modern economy today. When I say that, I'm not trying to overstretch. It's the basis of the modern economy today. If I bought this computer 3 years ago, today, and I bought a very similar one today, the similar one today would have more memory, a bigger hard drive, a better screen, a better processor, everything, and it would therefore be a lot more expensive? No. It would be a lot less expensive. Every business is being asked to do more with less. It's being asked to be more efficient and more effective, and if it doesn't, competition is going to go beat it up. So the reality is this is the basis of the modern economy. This is how everybody manages to make everything better, faster. That's the process improvement methodology. Is speed the primary objective? No. It turns out that it's much more important to have accuracy, predictability, manageability, accountability, compliance, and analysis. Now this is set up as an equation. Why? Because if you can improve everything above the line, that's the quality or the effectiveness of the process. If you can improve that, I guarantee you, not only does the speed become faster, but the cost becomes less, and it becomes easier. I'm going to repeat that. If you improve the quality of a process, it will become faster, less expensive, and easier. And the question is, can you do them all? No, you must do them all, because it doesn't work backwards. If you just ask people to work harder and you take some of them away, it doesn't become quality. It only works one way. You increase the quality, and the speed goes up, the cost goes down, and it becomes easier. A fast close is not necessarily efficient, but an efficient close is absolutely faster. We believe you should start with your close process or any other significant process. We believe you should optimize it. We believe you can take the benefits of what we're talking about and take them to other challenges like tax and SOX and audit and improve those pretty manual processes. Take those benefits, move them to some of those unique things that your company does that no other company does, that you can't find a system and you do manually, and those things that are the hardest. And our ultimate goal is to help you have integrated, optimized, continuous process improvement. Can you leverage technology? You absolutely should leverage technology. Technology that's making things easier, things like electronic work papers, things like dashboards and status checking by user, by activity type. Know when you're done. Have some technology help you. There's a couple available out there. If you have any questions about it, we can talk about it. The technology should integrate with SOX. There is no reason why you should do a process and then do additional work to do SOX. The technology should integrate with your PBC schedules and all your audit support. It is ridiculous to do something and then redo it for compliance, and then redo it for the auditors. All of that should be seamless. In terms of doing optimization, we have a white paper we've put out. If you're going to do an optimization project and you're going to use continuous improvement, you need to adopt that culture. In planning, you need to think about getting work done between the closes, taking incremental steps, not disrupting the close. You need to make sure it's a positive implementation. That means it is nothing like an ERP system implementation. You need to make sure that you're making continuous improvement, that you manage expectations, that there's no initial re-engineering, that you never slow the close. When you do something like this, you have to break it apart and do a little piece of it. There is a way to do implementation that is not like an ERP implementation. I will say that 10 times. It's not like an ERP implementation. It's not like an ERP implementation. Break it out, make it smooth, leverage what you learn from one part to the other part. Start doing your continuous process improvement. Start making things better. You will make more progress faster than you could, ever dream of. Lessons learned. There's a couple here. Overplan, expect delays, build an adaptable plan, never slow the close. Okay? Understand, planning determines success. Smaller, faster wins build momentum. Don't start with the hardest. Link the benefits, and understand scope creep. The answer is the scope's going to creep. It's kind of like at home when you hear, honey, we're just going to change the countertops. It's not going to happen that way. You are going to do more than just change the countertops. Under promise, over communicate. This is a significant change. If you're going to do continuous improvement, you need to focus on, listen to this quote, we have monthly management meetings where we think about how we can do it better. Not just get to a 4-day close, but how we make our information better. I want to thank you very much for having joined me. I want to offer you that in FEI September issue, there is an article called How to Safely Optimize the Close. And then I believe, Ernie, we're going to Q&A, correct?
Yes, Gabe. Thank you very much for that fantastic content. With this, we're going to go ahead and open the Q&A session. Just a reminder, if you have any questions you'd like to ask Gabe, please enter those questions in the questions area, and you go to Webinar Control Panel. I'll tee up the first question for you, Gabe. Someone has a mandate from the CFO to really shave down their close time from 9 days to 4 days. They'd like to optimize this, but they really have a full plate. Where would you suggest they start on this project?
Well, my categoric suggestion is that you start by taking a course or by having a kickoff sort of training to understand what the challenges is you face. We got to pull the people together. We got to do a quick sort of survey event. We got to find out where the low-hanging fruit is, and that's different at every company. There is some low-hanging fruit. There are some things that can be improved, and you got to start there because A, you build momentum. B, people start accepting what's happening. C, people generally are concerned about large changes, so you want to start with small changes. I read something very powerful that said the solution to really, really big challenges are a lot of small, very smart solutions. You don't solve something huge by trying to go build something even more huge. You start looking at it, break it apart. Everybody's heard, the analogy about an elephant. You grab the leg and the ear and whatever. They all feel different, but when you step back, you realize it's an elephant. How do you eat an elephant? One bite at a time. But the most important thing is, which bite do you take first? And how do you build momentum to get through the entire elephant?
Okay, great. Thank you. Just want to kind of follow up on that. So you mentioned that there is low-hanging fruit. It might be different across companies. However, are there any? What are the most common bottlenecks that people seem to have in the close process that really slows down that close process in your experience?
In my experience, a lot of it has to do with the review. We tend to send a bunch of stuff to one person or two people to review. Those reviewers, generally, the preparers get behind and the reviewers get slammed. We look at workload balancing and sort of and trying to figure out how do we get more people involved in the review, because if not, we have natural choke points there. People have never seen the entire process, so there's visibility issues. And frankly, people don't, at the end of the close, you ask people what happened and what were the top 2 or 3 things that went wrong. Everybody gives you a different story. So sort of having one version of the truth, having those meetings where we get together and figure out what is the low-hanging fruit, rearranging where the reviews are all happening, and the PCOAB is jumping into that game and wanting some evidence, so we need to talk about how we don't get into trouble with them. But rearrange some of the review, have some monthly meetings to really figure out what the top priority is. If everybody's got a different top priority, nothing gets improved. You got to take the whole department and boil it down to 1 or 2 or 3 of the low-hanging fruits and then focus and get the wood behind the arrowhead and solve them. I got 19 people working on 19 different priorities in 19 different directions. Nothing gets accomplished.
Okay, great. Part of the overarching theme is that there needs to be a holistic approach. If we speak to technology, there's a lot of cloud applications, and people are kind of falling in love with the technology. What are some of the common mistakes that you're seeing in regards to technology selection and then the implementation side?
Right. So two of them I'll give you. In terms of technology selection, people are trying to look for one silver bullet to solve everything. If you look at the large ERP companies, if you really talked about the last mile, they probably have 6, 7, 8 different modules that address chunks of it. So it's not one silver bullet. You cannot deploy one thing to solve everything. Okay? Every vendor will say, if you solve our thing, that's the big deal. The issue with the close is you could solve the next 3 big deals, but you're focused on the wrong place. What stops you from being closed a day earlier? It's not your ERP system. That thing was done 5, 6, 7 days before. It's not stuff you ran through some other system. That stuff was done 3 or 4 days before. It's the small, little manual things. So you need to focus on what's happening at the end, right? I got a lot of companies that are doing tax provision on spreadsheets, okay, and that are doing tax provision in a we're waiting till everybody's done and then we're churning it in a spreadsheet. Guess what? And there's like 900 steps and nobody knows what they are and only Sally can do them and et cetera. It's crazy. So you have to find the slowest things and prioritize those, and everybody tends to prioritize the biggest things. If the biggest things are fast, you're prioritizing in the wrong place. And then in implementation, everybody goes for these big bang long implementations, and those just cause a lot of disaster, make people very nervous, and they scope out the slowest things. When you implement an ERP system, you focus on all the biggest things and the slowest ones are out. So implementation's done kind of backwards, selection's done kind of backwards, and it's not a mystery that we've been dealing with this for 40 years.
Okay, great. I used to work at a manufacturing company, and those in the accounting close process, especially in the consolidations area, were very adverse to changing the processes. So can you give us some insights on how you build that internal consensus at companies?
Sure.
Or whether it's to change?
Absolutely. Because part of the issue here is people don't fear change. People do not fear change. I will prove it to you. I'm going to propose one of the biggest, most significant change to everybody who's on this phone right now to their own personal life. I'm going to propose that I could double their salary. Nobody had any fear about that. They all got big smiles on their face and were wondering, so when do we do it? So people don't fear change. They fear the unknown. Now, when they don't completely understand the process and somebody comes in and says that they're going to put on a new process, but those people who are putting in the new process don't really understand the business, yeah, I would be very fearful. And that's why accountants don't want to change things, because nobody's standing there going, and I guarantee you it'll work, and if it doesn't, I'll be here to help you fix it. So the reality is it's a process that's not well understood, well documented, and it works today. And there's a kind, gentle soul called the CFO, and if you break that process, everybody's staying as late as it takes to get it done. So the issue here is to break it into little pieces that you can understand, prioritize, and make the improvement. And so it's that visibility and the being able to understand a piece of the process well enough to be able to tell the person who you're changing it, look, it's not going to break when we change it. Here's how we understand it. We understand the business around it, and I'm going to be able to take 5 hours out of what you do without breaking the process. If you can convince somebody that you're going to take a bunch of hours of effort out and you're not going to break their process, how many people are going to tell you no, Ernie? It's the problem of convincing them that you're not going to break it when you change it because you understand it and you've let them understand what you're doing. That's what they're fearful of. So if you can get over that, people welcome process improvement if they understand it and they don't fear it's going to blow up on them. Does that make sense?
Oh, sure. Another question for you. Do you advise on some training in project management and also on Lean Six Sigma before starting these types of initiatives?
Well, actually, Lean Six Sigma is interesting. We've spent about 4 years modifying and picking and choosing certain parts of Lean, certain parts of Six Sigma, certain parts of Agile that is extremely helpful, certain parts of other process improvement methodologies to come out with something that works in accounting and finance. Just straight Lean and straight Six Sigma do not work in things like the accounting close or tax provision or those things. Those things were designed for machines and for manufacturing. They have great elements and great philosophies. Don't get me wrong. I love Lean. I love Six Sigma. I love Agile. But you have to modify them a bit so that they work in accounting and finance, especially in the more intellectual, more people-oriented side, because we're not machines. Lean, for example, or Six Sigma, for example, would tell you that being early is just as bad as being late. No CFO in the world is going to get mad at you if you're 2 days early, and they're going to be furious if you're 2 days late. So in manufacturing, early and late are equal. Here it's not. Here it's not. Does that help?
Sure, absolutely. Can you give us some insights on which of your optimization projects have implemented the best results and how long those took to implement?
So for example, we worked with a company called Invacare. This is a large U.S. publicly traded company. They started off with 9 people in financial reporting. We had those 9 people up and running. The way we do our projects is if we start working with you in September, you start deploying both. If it involves technology or if it involves process improvement, you start deploying those improvements. You start deploying them in October. The issue is this. The traditional approach would tell you that map it all first and then implement it 6 months later. These processes are manual and they change all the time. So what we do is we break it apart into logical pieces. Whatever we work with you in September, you're live in October. We'll grab another piece in October and you'll be live with that in November. We'll grab another piece in November and you'll be live in December. You might not want to do anything in January because the auditors are coming, so we'll skip into February or March. So we break it down into little pieces, but the companies start working. So with Invacare, we started with corporate accounting and 9 people. Today we've worked with over 150 people on their closing team, people in China, Australia, New Zealand, sites all over Europe, all over the US, Mexico, Canada. They manage over 4,500 manualized activities around the globe across those 150 people getting the accounting close done. And that's not an abnormally high number or anything like that. The issue is they know exactly where every spreadsheet, where every email, where every document, where everything is. They know who did it, what procedure they followed, how they did it, and everything else. And they started off 1 bite at a time, 1 month at a time, and they'll tell you it was one of the easiest implementations they ever went through. So depending on the size of the company, how long you're working with them, and depending on what else you're working on. Today, we've helped them with almost 40 different processes. We've helped them with the tax process. We've helped them with SOX. We've helped them with audit. We've helped them with the audit PBCs. We've helped them with close. We've helped them with cash receipts. We've helped them with a bunch of different processes, most of which feed into the close, but some of which have nothing to do with the close. So process improvement, once you learn it in the accounting close, you're going to use this for a lot of other places. This methodology and this everything that we do with people is completely transferable to other things, and that's why it's financial effectiveness. The close is just one process, but there's plenty of other processes that they have that can benefit from this stuff too. And remember, if their other processes aren't fixed, the close will never be fast.
Okay, great. Someone's asking about your view of the relationship between close optimization and market valuation.
My belief is that there's been some research done that companies that close faster have higher multiples and higher, which lead to higher market cap. When SOX first came out, the companies that historically had more issues, expended more money, and took longer, they did some research that showed that they had historically lower market multiples. Even amongst peer group companies. So if you're asking me if better run companies generally have better run finance departments that generally are better companies that generally perform better, I absolutely think that there's a complete correlation. I was working with some private investors that basically said there's 3 types of companies. There's those that can give us the information when we ask for it. There's those that will take a little bit of time to give us what we asked for, and there's those that we don't invest in. Those were their 3 buckets. If they have a hard time getting financial information together, we don't want to invest in them. So the reality here is, yes, it's important, and it's a reflection of everything you do.
Okay, great. Thank you very much. I'm going to go ahead and ask one more question before we close the Q&A session. So just to help us put a point on all the great content for the sake of argument, I'm a practitioner, and my financial close process is basically a mess. So you can give us some maybe 2 or 3 pointers of where it is that I should get started to improve the close process.
So it's interesting because I did put together that article for FEI, and one of the sub-pieces that they asked me for was exactly that. What should I do to start? The article has 3 things. It has what will a close look like, what are the general excuses, and what are the first quick steps to do. So a lot of the first quick steps are, first, understand the payoff. Understand what benefit you're going to get, because if there really isn't a benefit, going through and redoing everything doesn't make any sense. Second is get some education on how to do, and you mentioned earlier, how to do some of this process improvement, how to break it apart, and how to plan it. Third thing is build consensus in the team. Get the people to agree Get the people to agree and do that. Fourth thing is plan it so that it's small incremental steps. Do not try and do giant explosions and these big bang integrations. Where does a bang come from? That's not a good thing for me. So do it. Many companies, when they're going through this, the CFO doesn't even know we're working on the project, and that's beautiful. That's exactly where you want to be. So there are a lot of quick things, and as I said, there's a wonderful article in FEI magazine for September, and if people send you an email or me an email, we'll be more than happy to send it to them. So you go through and you understand the payoff, you learn about closed process improvement, you perform an assessment, you make a plan, and you take some action. Everybody keeps saying, we'll do this tomorrow, we'll do whatever. Start taking some action now. Sign up for a course. There's several services out there that offer them. Sign up for a process improvement course designed for this purpose, right? Take some action. Let's build a plan. It doesn't have to be a superstructure plan. It might take a day or two to build, right? We typically will build them for smaller companies within 2 half days. Medium companies, it'll take 2 days in the field, and large companies, maybe we'll be there for 3 days. So it's not that hard to build a plan. And understand the plan's going to change, so you don't have to build, you're not going to write War and Peace. It's not what you're looking for. You're looking for a plan of what bites can we take to get this plan to get this project started that makes sense.
Okay, great. Thank you very much, Gabe. Sorry to cut you off there. In the sake of time, I'm going to close the Q&A session, and we will coordinate with Gabe in getting any unanswered questions posted on performative.com. As a reminder, you'll be prompted to take a short survey once the webinar concludes. We greatly appreciate your feedback regarding the event, and we invite you to join us at www.performative.com to ask any additional questions you may have and to continue the conversation with your peers and experts you heard from today. A big thank you to Gabe for his time and insights. He's clearly a thought leader in his field and an excellent source of information on today's topic. Note that in the post-webinar survey, you have the opportunity to express your interest in being connected with Gabe with just one mouse click. Finally, I'd like to thank the audience for your valuable time. We hope to see you again soon at another Performative event or online at www.performative.com. Make the rest of your day great, everyone. Thank you very much.
Thank you very much, also.